You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host. As always, it's been a few months since we've spoken about the commercial market in Western Australia, but it's the right time to have that chat post-election. Interesting but obvious results coming through, and it's really just business as usual, I'd say, going forward for the next 4 years when it comes to our interaction right now, at least as we know, with John Kerry still as the Minister for Housing right now with regards to the property market as investors, as developers. And we speak a lot about the resi market, but it's time to have an update on the commercial market with the man I trust most to give me that broad information about the industry. He's very hardworking, very industrious, and on the pulse, it is Luke Randazzo from Burgess Rawson. How you going, mate?
Good. Thanks for having me, Trent.
Interesting result on the weekend in the state election, but one I guess that 99% of the population had their money on. Do you think that has any impact in the way that people look at the commercial market in West Australia right now?
I think because it was forecast long out that this was going to be the outcome, that hasn't really changed a whole lot. There's no real shocks, so I think it'll be business as usual and not too many major shockwaves in our market anyway.
Probably a good thing, right? Because we price in risk into our cap rates, our yields, and especially in commercial property. It's nice that we don't really have to factor in much risk at all in this. Whether you like the government or you don't, it is what it is. It's not changing, and I guess change is risk when it comes to commercial property especially, isn't it?
Yeah, generally if you're looking with a private enterprise lens on, you're going to be leaning toward the libs, but in this case I think, no change and no volatility is always a positive, absolutely.
We like stability in anything investment, not to mention property, especially not to mention commercial property, which obviously has a much more complex lens. Let's do a quick overview, if we can, about where the commercial market sits. When we think about commercial, for everyone listening, it's pretty much everything that's not a house, right? It's office, it's childcare, it's medical, it's warehouse, it's storage, it's fuel, it's retail, it's big box stuff. It's a broad industry, isn't it, Luke?
Yeah, it certainly is. I think you've just about covered most of those asset classes there.
Episode done.
Yeah, rock and roll, we're finished. Look, I think WA is still doing really well. There's a lot of cash in our economy and there's still a fair bit of confidence. I get asked on a near daily basis what's happening in the market, and I think the worst thing you can do is read the AFR or the Australian, because they're very East Coast focused and East Coast centric, and the drivers in the WA economy are very different. There's still a lot of confidence in our market, and the key metric I use, it might not be right, is the iron ore spot price. I've always said if it's over $100 or around about $100, then we're all doing okay, because that multiplier effect kind of filters through to the rest of the economy.
So that's your analog. You're looking at one key metric there, and you think that really broadens out the dynamics of demand and supply, which are affected by population growth, affected by construction costs and all that. As long as the iron ore market is strong and you're putting that at $100 a tonne just to relate to a profit line for the big companies, then everything else should be all right, especially in the commercial market.
Very broadly, there's a lot of other factors that are at play, so it is a very broad sense, but we are in many ways a one-horse economy, and while resources of mining are pushing along, that'll lead to more cash and more confidence. Yeah, if I was speaking on one metric, that's the one I'd use, certainly.
Okay, so let's dive a little bit deeper and have a look at what's one of the more sensitive markets in the commercial space in WA. It's probably a bit of a barometer as well, is the office market, and specifically, I guess, the city fringe market. If it's full, it means we're bustling. If it's empty, it means we're consolidating, right?
Yeah, look, we've certainly had a change in the city fringe office market, and city fringe is where I specialise, more so than leasing big office towers in the CBD or selling those towers, and they're really two different stories of what the vacancy looks like and the demand in the CBD versus what it does in the city fringe. So city fringe, for example, is suburbs like Subiaco, Herdsman, Balcatta, Mount Lawley, Leederville, South Perth, Stirling. And since 2019, we've had a halving of vacancy in those suburban offices in general.
Has that been robbing Peter to pay Paul? Are people moving out of the city because of COVID, because the city stinks a bit, are those sort of perceptions, and then moving there? Or is it because there is just more demand in the market generally?
I think, if you'd ask a CBD office leasing agent, they'll probably tell you the vacancy's gone down as well, which is great. But specialising in the the suburbs, I think the whole working from home phenomenon has changed how employers view where their office needs to be. Convenience of how close is the office to home, how close is it to coffee shops and restaurants and bars. A lot of these qualitative factors and the need to have a St. George's Terrace address has changed. We're on the terrace and I think we need to be on the terrace, but there's plenty of businesses who have changed that priority and downsized or resized and moved closer to home into the suburbs. It's definitely got a different stigma to it, yeah.
It's interesting how that dynamic would relate to the resi market. I'm just thinking back to 2019, 2018 even. The resi market was at about a 7% vacancy rate and we dropped to a 0.5% vacancy rate. So it's reduced by a factor of 14. That's pretty impactful, right? And that's obviously led to rents more than doubling. You're saying that the vacancy rate in the city fringe office space has halved. So it's still a good result, but I assume that hasn't had the same impact on what you're paying to lease a place out in that office space.
No, it's a lot of time people do get somewhat convoluted in thinking that commercial, even sale rates have followed that resi boom that we've experienced over the last 18 to 24 months. I think a lot of the time it's been more about filling vacancies than it has watching really strong growth in leasing prices and purchase prices as well.
So just a lot of soaking up of extra capacity on stuff that isn't premium grade office space.
Yeah.
Things that could have been sitting there for years.
Yes, but at the same time, it's still a flight to quality. That's a term that gets thrown around a lot. And that high quality office space, which may have been 2,000-3,000 square metres in a certain precinct, Herdsman's a great example, is now being soaked up. And then there's probably less of that to go around.
Now, I know this is really niche for people and thinking, why are we talking office space, Trent? How many people buy office spaces? We're trying to look at doing a small subdivision or a passive investment right now, but I think it's important to use it as a barometer because it talks to small business activity. It talks to how much money is flowing through the economy. I've just asked you about leases and the impact that it's had, and I guess the answer, as you've said, is somewhat, hey, it's just good to have an office filled with 100% occupancy rather than empty. But I do know I've heard of places, for example, like Subiaco, that have seen some pretty marked increases in their leasing rates per square metre over the last couple of years, right?
Yeah, it's just subject to demand and supply. So Rockaby Road, vacancy's gone down significantly. You even look at other major retail strips, not just in Subi, but Oxford Street in Leederville, Beaufort Street in Mount Lawley, just demand and supply. And as those shops fill up, the natural kind of flow-on effect is that then your rents start to go up. And the counter to that is if it does get too hot in some of those precincts, then the rents get a bit too spicy to say, and then they do the full circle and go back to vacancy and start again.
I guess the only difference with commercial, especially the office space, but all commercial versus resi, is that the lease terms are obviously a lot longer, they're chunkier.
Yep.
So if you're not comfortable in your office, you've outgrown it, it's too expensive, you've gone belly up, you're still obliged to pay this rent and stick here for quite a while. And it's really hard to be super efficient about moving in from one office to the next without having overlaps.
Yeah, and often we have those conversations with tenants and buyers. There's a fear of growing too fast, a fear of what does the future look like. When they sign leases, it can be anywhere between 3-5 years for an office deal. It can be less sometimes, but things do change quite quickly. So if you've signed let's say a 3-year deal for an office and then you lose your major contractor or major supplier and all of a sudden you need half of that space, then you're still locked into a lease. Or vice versa, you go crazy on growth and you need more space, but again, you're still locked into a lease.
Yeah, and that's the risk of being a tenant running a business. We all have to factor those realities in. You do as an owner at Burgess Rawson. You have a lease that you're paying. I have a lease I'm paying. We just have to factor those risks in, those inefficiencies that come with that office space risk, especially if you're outgrowing your space. That's really tough. I think.
And I think businesses are always looking at how they can do things more efficiently as well in terms of layout, functionality, concepts of hot desking. There's so many different ways you can look at how can we be more efficient. We've seen businesses bring in other businesses that are complementary to sublet 20 or 30 square metres in their office and go, now we're all under the same roof. Perhaps there's some more efficiencies because, for example, like your business, if you didn't have a settlement agent business, you might bring a settlement agent under roof with you. Then you do things more efficient because you tap someone on the shoulder. You're not having to get in the car or pick up the phone.
Yeah, that's a good point. And I think the reality is, whilst a lot of people are coming back from working from home situations, a lot of big businesses starting to get a little less patient with people in that space as well, and saying, hey, this is actually not very productive for us. We need you in the office so we can make sure you're doing your work. Whilst that is happening, there is still a bit of fat in the system and flexibility in the system that that didn't used to occur in the mindsets of officers back then. So I think that's always going to lag on the occupancy rates going forward. And I guess that we can segue that into the risk that we see right now to be buying into something like an office space or any other right now. They all have their risk profiles, and so you might say that the highest yield you'd be buying in commercial right now might be office, because it might be perceivably the most risky, and the lowest might be industrial right now. And it's funny how those have flipped on each other's heads over the last 10 years. It could have been the opposite 10, 15 years ago in Perth. And in the middle, you've got all the other segments that I mentioned before, between the 5 and 7%. How much of that do we think has been impacted over the last year by interest rates? And do you think that the impact of having East Coast investors coming into our market as buyers now has been just as much of an impact, if that makes sense? I think what I'm trying to toy with here is the different inputs that affect what we will pay for a commercial property. Things like the interest rates going up and down. How sticky is that? If it goes up 1%, does our yield go up 1%? Have we seen that? Versus, I'm from the East Coast and I used to paying 4% for a childcare. Hey, I'll pay 6% for a childcare in WA. That's a bargain.
Yep. No, it's a very good question. And I think to your first point is office still does have that stigma of being probably a less attractive leased investment, and in that space of...
It is though, isn't it?
Yeah, it comes back to demand and supply, and obviously there is a lot of supply. Generally the leases are not going to be as long as, say, service commercial, retail leased investments, even medical investments. In that smaller space, $0 to $2 million, office leased investment market is borderline non-existent, and I don't mean to be pessimistic. Industrial is now the prime time of the last few years, and certainly the flavour of that period of time, but then retail, medical, childcare, so childcare in probably the next echelon up in terms of price point though. For the mum and dad investors, you're not really going to pick up a childcare below $2 million. It's very unlikely, especially the new ones. We're more talking $4, $5, $6 million. In that little space, what we've seen from the introduction of East Coast buyers agents has been really significant. And I'd say they've been in town now for probably 2 or 3 years. And every agent who's listening to this knows who the guys are and who to call. And
the dynamic, how do they operate?
You get a leased investment, and they prefer off market, but they'll play on market as well. You get a leased investment, you call the buyers agents, and then they pretty much give you some terms or what type of yield, which translates to a purchase price that they can pay based on their database, predominantly based in Queensland, Victoria and Sydney. I think they're somewhat pricing out WA investors, because WA investors are probably not quite as bullish as these ones on the East Coast. And I think that is driven by the fact that your, let's say, investor in Sydney goes, like you touched on, that same product, proximity from the CBD, rent, in Sydney is going to be 1.5% sharper than it is in WA. So seeking a safe haven, which I still think WA proved in the COVID period is a safe haven, both physically and from an investment point of view, and B, superior yields. So I do think they're pricing out investors.
Both spaces, the resi space as well, right?
Yep,
so
correct.
I think it's that lack of sensitivity. When you come from Sydney, you see a house that's 15 k's from the city and you go, oh, that'd be 2 mil in Sydney. 1 mil, 1.1 mil in Perth. Who cares? It's not 2 mil. I'll pay what I have to.
Spot on.
There's really that nonchalance nearly, right?
Yep.
And the same thing I think you see from a cap rate perspective, a yield seeking perspective as well, where it's, hey, I could buy this BP fuel station 5% in Sydney. It's 6.5% in Perth. Is it 6.5? Is it 6.6? Is it 6.4? Who cares? Just buy it. It's more than 5 and it's a BP and the cars still need petrol.
Same covenant.
Exactly. And then people over
Different
here are
election.
looking at it going, oh, I know the suburb. I've driven past it every day. I have to analyse it. Yep. And they've lost the deal.
And you've got to remember as well, from a mentality point of view, those East Coast, Sydney is a great example. It's so auction focused. So you come here, and how often do we do auctions here? Very rarely.
Well, we don't even track auctions.
So it's the same approach even to commercial, is they're just more bullish. Whereas I think the investors, and I'm probably no different, I don't know if you're any different, but there is a little bit more, probably more of a conservative approach and more that to tick every single box of your desktop due diligence before you put pen to paper. So
yeah, there's definitely a bias that we've seen on both sides of the coin. It's interesting to have that chat about the consistencies between the two markets here and the way that East Coast and local buyers actually approach the assets we have. As nearly this self-defeating bias we continually breaking or trying to break in WA.
Absolutely. But look, I still see opportunity for WA investors. I think East Coast buyers, because they are buying these things, it's somewhat sight unseen because, yes, it has a valuation and there's due diligence attached, but they don't actually probably know the suburb or the product or the operator. I think there's opportunity for WA investors where you probably have to put a creative mindset on, where there might be some value add opportunity, there may be part vacancy, you might have a lease that's coming up within the next 12 months or so, and you have to have conversations with tenants, either tenants that are in situ or other tenants and real estate agents, just to try and be a little bit more creative in terms of putting a deal together and then actually creating your own value. Because if you're doing a deal which I've just described, you're not buying that at 5 3/4 or 6%. You probably get a yield that pushes to 7 or 8%.
That's really good advice. So your advice is really, if you're not comfortable, don't compete with the East Coast investor. Try and find a way to not compete. Try and find a way to reinvent the wheel, add value.
Put some work into it.
Yeah, and because you have that local knowledge about, hey, you know what? I am buying an old gym here. This local gym operator isn't in the rest of the suburb. I reckon next year I can bring them in.
Yep. Or does it have to be a gym afterwards?
Yeah, good point.
Can I repurpose it? So
there used to be a medical centre and it closed down a few years. Maybe we can turn it into that.
And then you look at key kind of fundamentals. Say it might have a lot of parking if it was formerly a medical centre or even a gym, and then you can identify other uses by finding, like, parking is everything in having medical consultants or gyms. So there's just different angles you need to take, I think. And you don't have to be a real estate expert. That's why you talk to agents and sound out where is the value add, because if you're just buying something kind of cookie cutter, even if it's a strata, for example, I don't know where you add value there, but cookie cutter, tenants already in situ, then you're just doing a pure yield play. But if you can find some form of an angle to add value, it certainly changes the dynamic of your investment.
Well, it's an interesting perspective, because what it is a sort of recognising that East Coast buyers have been and continue to be more bullish and a little more frivolous about the way that they invest in our leased investment market. And unless you want to change your mindset as a local, the best way is then to just do the extra homework, do the extra work.
Absolutely. And maybe see some gold where someone else might not quite see that.
So let's say I'm a young person, or let's say I'm a punter.
Yep.
So I'm humble enough to call myself a punter. I've bought one property, maybe I've got one investment property, and I've given up in the resi space, and I'm looking to make that first purchase in the commercial space because I see opportunity in something that's not just a lease investment. I think I can do something special with this site that I've seen sitting there for years on the corner of whatever distributor road that I drive past every day. What are those basic 101 things that you would say to your best mate at your wedding who says, Luke, you know everything about commercial property. How do I get in there? Think about finance. Think about how much cash I might need, about the entry points. And probably also, if you can, some of those easy landmines to step around. Don't buy this. I know it's easy to look at that, but just do not buy this sort of stuff.
Yeah, I think there's a few key points that I would give as advice to any young person or any first-time investor in commercial real estate. It would be, number one is to understand the asset and what class it plays in. So firstly, understand what are you buying? Is it industrial, office, retail, medical? And then that kind of flows through to number two is if it is tenanted, make sure that your tenant is sustainable. So being sustainable means, can they afford the rent, and is there a genuine demand for their service in that location?
So don't just take the rent for granted. Just because there's a lease doesn't mean that they're going to be paying you.
That's right, absolutely. You just read the lease and go, this is amazing, but what if your tenant 6 months later falls over because you've bought a childcare centre and then there's 4 other childcare centres on each corner nearby? So I think it's really important to understand the market that your tenant is serving, and then to understand that is sustainable, because they're not going to be able to pay the rent otherwise.
That's the big perceived risk in commercial, isn't it? Is that with resi, if the tenant stopped paying, there's a stuff around, you got to go through court, you kick them out, and a couple of months later, you've filled it again.
There's a roof over their head, yeah.
That's right. But with commercial, it doesn't take a rocket scientist to have seen in many parts of Perth over the last 20 years, some places just sit empty for years, and you got to pay the mortgage on that.
Absolutely, and sometimes they sit empty because you've got owners who have more money than sense and it doesn't really change their position. Sometimes it sits empty because owners are not conditioned to how much rent they should be getting or what sort of works they may need to do on the building to make it more attractive.
So they don't want to drop the rent because that invariably drops the book value.
Yeah, the value, that's right. Yeah.
So they'd rather just keep it empty and wait.
Absolutely. So you have all sorts of case scenarios there, but
you can also have the situation where you had a tenant, they went tits up, or they grew and left, and now you're stuck with an empty place.
Yeah, absolutely. And that comes back to when you buy it, you almost need to have that safety net. And a safety net doesn't mean, I have a second tenant lined up for the next 5 years. That's just ridiculous. But you have to have a plan of, if my tenant does leave, what are we doing?
You'd be getting in contact with the tenant. You'd be meeting the tenant, right?
Absolutely. It'd be in your interest, or if you've got someone representing you, to speak to the tenant. And what are your intentions? You might have a tenant who goes, once the lease wraps up, my wife and I are retiring. We're shutting shop and good luck to you in 3 years. You've got to go find a new tenant. I think that's important. Just understand that the fundamentals of who your tenant is and the market that they're serving. Another piece of advice I would give is understand the true market rent in that space, because what someone is paying according to a lease and what market rent is, often, not always, but often can be different figures.
Because it's been years since they signed the lease, right?
Yeah, in different markets, that's right.
Pour down.
There could be opportunity, that's right, to do a market review and then correct that rent, or there could be, probably the scarier side is where it's over-rented. It could be over-rented by, let's say, 20 or 30%, and then if that tenant does leave, the property you bought that looked really good at 7.5% and 8% on paper, we're now talking 4 to 5% on paper on a return, because you've got to correct it and go, A, you've actually got to find a tenant, and B, then you've got to go market rent.
Yeah, and that's a real risk,
Yeah,
that the book value is dropping through the floor by that amount. But you mentioned that opportunity, and I think this is an opportunity that I've seen a number of people start their own business on, is literally just going finding assets where it's under rented, where it's a good business. We know they're doing well. We've looked at their lease. We reckon that the market rent's $150 a square metre and they're paying $99 a square metre. We reckon that in the next 2 years when they have a rent review, they'll want to stay and they can afford to pay $150. Suddenly, they're paying $150 on a 5-year extension, and the value was just straight away going up 50%.
Exactly, and the yield might still be 6% from when you bought it, but it's gone up significantly. And I think I don't play in the industrial space, but certainly we've got a big team at Burgess Rawson who do, and a lot of those owners, people who've held their buildings for years and years, and even those who bought recently, let's use Malaga as a case study, were $85 a square metre. We had to offer, or agents had to offer rent-free, normally in the line of 1 month for every year of a deal. So you do a 3-year deal, you get 3 months rent-free at $85 a metre. And then industrials experienced its total exponential growth to the point that Renaissance is an understatement. Its rents are now as high as $140, $150, maybe higher than that. So, and no rent-free. So, you know, tenants are almost just being grateful to have a space. Yeah.
And
so you look at that.
Nominally, it's gone up 80% in value.
So
you haven't done anything to it.
Exactly. So you might say we're still at 6% or 6.5% or whatever it is, but now the rents have gone up 40, 50, maybe more. That the value of your building has gone up the same amount.
Yeah, and you haven't even painted it.
No, exactly. And sometimes, often investors, they're not gurus. They're just bought at the right place at the right time. So often.
And I think that's where the opportunity is, where commercial, if you get it right and if you can not be happy-go-lucky about it, but actually have some nous about what you're doing, this is where those resi investors who are stuck with the passive markets on the surfboard, waiting for the wave to come, making sure they're at least catching that wave with the other people on a surfboard. Commercial is like getting on the jet ski. As long as you've got enough fuel in the tank, you can overcome any waves that come through and smash through at much faster speeds if you get it right. Otherwise, you're stuck out there stranded 300 metres from shore.
Correct. It's all about sound fundamental approach. It will work for some approaches where you do buy it, the rents are maybe at the top of the market and you're still buying at a relatively sharp yield. But if they turn, then like I said, your valuation turns pretty quickly as well. But if you approach it that, what is the market rent, what is a market yield, and you're buying with those fundamentals in good and bad markets, you're safeguarding yourself, I think, in boom or bust markets. So
yeah, and at the end of the day, it's when you get to that level of sophistication and you can harness these outcomes that you start to see some real market-leading exponential growth where you're making a big difference financially to your outcomes in your life. Another point I think is the finance side, right? I don't know if you were going to touch on that, but you can't be going and getting 90% LMI loans in commercial. You've got to have a bit of money about you to get into these things, right?
Yeah, rule of thumb has always been resi's like 20% deposit and 80% from the bank. I think commercial still rule of thumb might be more like put up 35% and then look for about 65% from the bank. Obviously it depends on your financial institution, your relationship, the assets you've got, if you're going to gear up some of the other stuff you're holding, but generally you do have to stump up a little bit more. And it comes back to that fundamental principle of, like you said with a house, if it goes vacant, people generally need a roof over their head. There's better returns on commercial because there's a little bit more risk attached.
That's right. So you need more cash, your interest rates are a bit higher as well.
Yep.
You've got some fees and they just take the piss a bit more, the banks, when it comes to commercial, because they can. But you start playing with the big boys there, so you just got to cop what those fees are and what the interest rate is. So yeah, you need a bit more about you to get to there, and that's why I think for most people they graduate from resi and get into commercial, both from a financial point of view, but also from just a competency point of view too. Hopefully these things happen at the same time and you can make a good deal with the money you need.
Yeah, often it's a natural kind of evolution, and commercial can be really attractive. Your tenant pays all your outgoings, you have longer leases. Resi is generally a 6 to 12 month lease term. You have commercial leases that are a lot longer, built-in fixed increases. There's lots to like. I think I'd just advise caution in just jumping in without any advice or any kind of background on where to go. You have to have a plan on where to go.
You're right. It can be a lot easier. I think a lot of people get turned off by the resi market, especially when maintenance starts to become a factor in their life. It's just a real pain in the ass, to be honest. Tenants not paying their rents. To be frank, it's a much more professional situation in commercial. You've got property managers who are just looking after it. The tenant's paying for nearly everything, which is
maintenance is a tenant's problem.
You're a tenant. But it's really just quite a plug and play. It can be really easy to get in and out of the commercial market and actually make quite a bit of money if you know what you're buying and selling at the same time.
Even to the point that your property manager, the management fees, provided it's a commercial and non-retail lease, they're recoverable from the outgoings as well. So
everything's paid for by the tenant.
Yeah, it's pretty good.
Yeah, if you're a landlord.
That's right.
Let's have a look at the industrial market in a bit more detail, just as a bit of a shining light, I think, to what's going on in WA right now. I think a lot of people would have thought it would have had a couple of years in the sun. It's been like 3-4 years at least now, Luke, and doesn't seem to be any abatement on, for the most part, this warehouse workshop base in Perth, and we're just not supplying enough land to build enough workshops to house enough businesses that are in the logistics space, that are in the engineering space. They're making stuff, they're storing stuff, they're moving stuff, and with AUKUS coming through, you just start to think, geez, I don't know where it's going to abate, to be honest.
Yeah, absolutely. Like I said, my small disclaimer is that I don't really do much business in the industrial. We have a team who do that, but the main issue for all the, and not just our team, the main issue for across the sector is getting the stock, because it is so tightly held. The supply is really dwindled in the fact that it's been soaked up from probably the last 4 or 5 years, and it's across the board, from the small 200 square metre strata office workshop in Balcatta, Malaga,
50-year-old
Wangara,
brown brick buildings that no one would rent years ago,
to the 20,000 square metre distribution centre at Perth Airport. There's genuine demand for industrial assets across all classes,
both from a tenant perspective and an
owner occupier. And an owner occupier. Yeah. So that market is super hot at the moment, and it's just a function of demand and supply, and price goes up because there's greater demand than there is supply. So rents have really skyrocketed, and even owner occupiers purchasing warehouses. I've heard stories now where you're getting close to $4,000 a square metre in those real blue chip Aussie Park, Balcatta areas. That's serious money for a warehouse.
We spoke to Wayne Jawley a few months ago on Industrial, who was flagging to us that owner occupiers are buying properties that are leased out just so that they can put their hat in the ring, kick them out in a year and a half so they can move in.
It's incredible.
I mean, bloody hell.
It is. It's unbelievable. And then I suppose as a result, you then see the next suburbs out start to develop. So our guys in the office did the Neerabup estate, and that land sold really quickly. There's really high demand for that. And I'm sure, I think you've been involved in another development south of the river.
Yeah, down near the marine complex.
Yeah, down marine. That's the way it goes. It just keeps expanding. It's like housing. You just keep expanding to the next circle out, and then people will have to drive another 10 minutes to get to the place of business.
That's right. And to be honest, this is place of business, right? So it needs to be this industrial space, whilst you might not want to live in it. It needs to be close to where you live. Otherwise, you're driving for half an hour to get to work.
Yep.
So it is important that this stuff is not right on the fringes, even though Neerabup is on the fringes. But there are also housing estates these days.
Yeah, it's natural.
Not that far away,
It's a natural urban sprawl kind of resi and
when you have
industrial,
resi, you
commercial.
also need industrial. You also need commercial. They all come hand in hand.
Absolutely.
We're expecting rate drops to continue over the rest of the year. We've had 25 basis points a few weeks ago. We expect to see, I reckon the next one will be in May. I don't think they'll pull the trigger before the election because they don't need to, and they wouldn't want to be seen to be interfering much with the election. But I think May, the numbers are stacking up already that we need another one. And the markets are expecting another couple after that. I don't know how bullish that is compared to reality, but if we assume that most people make decisions based on expectations rather than just reality, Luke, and that is the expectation of the market, we've seen it, we know it, how does that bode for starting to put your commercial properties on the market if you were looking to make a bit more of a windfall this year compared to last year? What was the feeling last year versus what the feeling is looking forward into 2025 if I'm looking to transact in the commercial market?
I think what I would say is never undermine the power of market sentiment and confidence. They're words that get thrown around a lot, but market confidence in any space is so important. And I think, yes, that means the purchasing power of buyers has gone up. If you're a buyer, you're probably still competing with the same buyers because everyone now can borrow more, but it does increase market sentiment. If you're a seller, especially in that retail leased investment service commercial lease investment, even industrial lease investment, 25 basis points going down, not necessarily translate to 0.25% sharper yields, but it's going to be somewhere in between. So that coupled with market confidence and more spending is generally that term I used earlier, that multiplier effect. It's quite good for the market. So I think it's a positive thing, but at the same time, if you're in the buyer's kind of position, and not to put a downer or a caveat on it, it's not exclusive to some buyers and others. A rate reduction applies to everyone, and now everyone can borrow more.
Everyone can borrow more, and more people are prepared to pay more because rates are obviously lower with regards to their cost of capital. Does that affect some segments of the commercial market more than others? Are there some that are more volatile than others?
Yeah, I think it would be more the assets that may have looked less attractive that people may punt on a little bit more, because then you just have a go at a certain yield. It's not going to cost you as much. Like maybe office is a great example, and then you go, I might roll the dice on some vacancy. My borrowing power is a lot more now.
Holding costs are lower.
Yeah, holding costs are lower perhaps. But then in that blue chip, brand new childcare centre. Petrol's probably a different conversation now with the introduction of EVs, but retail leased investments, fast food, which doesn't come up often, and I think you'll see a direct correlation. Like I said, not maybe by 25 basis points, but you will see a direct correlation of sharper yields on the back of a reduction in rates.
You mentioned fuel and EV, and I know that's not exactly your space, but I've spoken to this a couple of times over the last couple of years, that the advent of EVs will at some point have an iPhone moment. I think it will have to. And how that impacts the market forecast for people looking to buy a fuel station as a leased investment. I think that there's two parts of this when it comes to fuel. One, fuel's going to be around for many years, decades still. It's not going to change. But two, they will ultimately have to reinvent themselves into just charging stations where you have even more of the profit-making part of your business being the coffee
convenience.
Shop, because everyone's got to wait 5-10 minutes now rather than 2 minutes to fill their car up. And so the offering's still the same. It's somewhere that some people have to stop to do something with their car. In the meantime, they'll browse the convenience section.
Yep.
I don't think fuel's going anywhere. It's just going to transition its offering, but it's got the same market in the same place.
I'm with you on that, but can a convenience store pay $300,000 or $350,000 per annum? So they'd have to really fine-tune their offering, that while people are there, they're spending money.
Yeah.
And maybe that's not just grabbing a sandwich, but
$2 coffee.
Correct.
Yeah.
Maybe buying a real meal and spending $20 or $30. But again, I've used the word fundamental a lot today, but you look at where fuel stations are located, and they are high traffic volume, high exposure, corner sites. Fundamentally, that they're still in great locations. If it's not petrol, do you find another operator that can spend that type of rent? I don't know the answer, but they're still in great core locations.
Yeah, you're right. And we're going to see how it plays out in the cap rate space anyway, what people are prepared to take a risk, how people are prepared to value that risk will come out in the yields they are prepared to pay.
Absolutely.
Luke Randazzo, I love having you in. It's great to have a nice, relaxed chat, but also a really informative chat where we can be practical about what it means to get into the market, especially for someone who hasn't been in it before, what we're focusing on and where our risk points are. Thanks for the chat, mate. I'm sure we'll have you in again this year.
Thanks for having me, Trent.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!